I want to go back to money market funds because people love these money market funds. $6 trillion in money market funds, astonishingly sticky money that's there. Is that money going to stay there now that yields are lower? Will any of it find its way into the stock market? And I want to get Jerome's opinion too on this.
Yeah, I think I think cash has been sticky for over a decade and been on the sidelines. And so we've seen different ways that clients have moved out of, or moved a little bit out further from cash. Maybe they've gone into a short-term duration ETF, or they have done things like gone into the treasury trade in the last 2 or 3 years. So I think that balance has always been very hard to crack, for sure. But I think the important thing is that you can still trade in and out of that when you want to. And I think the ETF is a really important solution for treasury exposure these days, so that you're not sort of locked into either a CD or a money market fund that's frankly probably a little overpriced. And there's a lot more price efficiency in treasury bond ETFs. These days you can
tell
trade
it
it
to
for
our
3
viewers,
basis points.
they get 5% in some of these money market funds in their retirement accounts.
Yeah.
You know, like Vanguard, and it's quite amazing that and they love it. They sit there and they don't worry that much.
I think there's a danger in that because they're not looking at what that product is, how much it's charging them. So if you're getting 5% yield but you're being charged 40 basis points for it, that's not okay in this market, because there's a lot of yield to be had in the treasury side and still in the short-term side, and you shouldn't overpay for your cash exposure. I think that's something that they should take away.
Jerome, you were making the point earlier about these money market funds that the amount of money that would probably find its way into the stock market from here is fairly small, but give us your thoughts on how sticky that money is in money markets.
Yeah, we've done a few different points of analysis here at PIMCO, and the first one is that when you think about the $6.5 trillion sitting on the sidelines in money market funds, it's not all meant to be put to work in terms of risk appetite. It's probably something around 15% by our assessment, which is a huge amount of money, you know, $600 to $800 billion. But at the same time, we aren't finding that it's going to be put to work on a dime. Days like today might incentivize people to put money to work in risk, but not necessarily motivate people to do that. At the same time, what we're also saying is that there's structural reasons why money market fund yields will come down. Obviously, benchmark rates moving down by Federal Reserve easing is the main culprit at this point in time. And if you forecast that we're going to have 5 or 6 rate cuts, you know, on the near-term horizon, as the market is suggesting, getting closer to that neutral rate of 3%, you're finding yourself moving from a 5% risk-free rate to a 3.5% risk-free rate pretty quickly on that cash. So how do you balance that? You move to those ultra-short ETF strategies, low duration ETF strategies, even the bond and core like ETF strategies that have actively managed components. And in doing so, you find yourself in a healthy way to earn structural premium, earn risk-adjusted returns based on spread products which are more attractive, and at the same time complement the market as it continues to evolve toward perhaps a lower growth environment than what we witnessed earlier this year, and an inflationary outlook which might be somewhat lower than what we've encountered over the past few years. So having the resources to navigate this landscape is incredibly important. And most importantly, diversification. We think that this environment is a requirement for diversification across asset classes. And so when you look at our complex at PIMCO, generally speaking, our strategies are leaning on that diversified approach across some corporate exposure, asset-backed securities, other high-quality assets, including agency mortgages. And that's incredibly important as we begin to navigate the different opportunity sets that changing liquidity fundamentals bring to the market. And that's where the value ends up being revealed.
So, Jerome, just a quick follow-up. A good part of the bond portfolio, BOND, the ETF portfolio you have, is mortgage-backed securities. Mortgage rates have come down over the last few days. I think we're looking at 6.4% mortgage rates now. For people looking for a home, where are mortgage rates going? Can you prognosticate on that? And where does mortgage-backed securities fit in with the bond portfolio?
Well, everybody would like mortgage rates to come down, and we think that mortgage rates will come down as obviously the spreads will tighten from the origination's point of view. More practically speaking for investors, the way we think about agency mortgages is a treasury surrogate, a high quality surrogate, plus some spread. And while the environment has fundamentally changed over the past year as regional banks have taken a step back from the amount of agency mortgages they're buying, we think it's a great opportunity to use it as a diversifier for our higher quality fixed income ETF portfolio. So for bonds specifically, it's been a growing part of that fundamental approach. And what might change is a technical factor about which coupon we buy, things like that. But as a baseline asset class, we think it's a great asset class and a diversifier given the spread components and the quality, nature, and liquidity of it versus the rest of the market opportunities that we see at this point in time.
Do you, Joanna, you want to take a crack at this, mortgage-backed securities? Any thoughts on mortgages, Brian?
No, I think there's a good point about investing in a multi-sector asset actively managed fund. We have an active fund that does just that. But what it does is it takes a spin on right now. You need someone to help you understand the relative opportunities amongst these sectors. So we violently agree with that. Our multi-sector product is called TAX, T-A-X-X, and it has two dimensions to it. One, it's optimizing for your after-tax experience, and sometimes in markets like this, and this is where it'll be interesting to talk about more, is that sometimes it's better if you are in investment-grade securities, or you're adding mortgage backs or non-government securities, and or munis. And so I think Jerome's right. There's ways that professional active managers can help you navigate these opportunities, which aren't as easy to see if you don't have the perspective.
But you seem to be talking both sides here. I mean, I'm a Jack Bogle guy, so Bogle would have argued you should own a broad, diversified bond portfolio. There's a reason AGG is such a diversified fund, and yet we sort of talk like market timing works. Like we're going to get out of high yield now. We're going to go more into medium duration corporates and medium duration treasuries. And yet, if you own a broadly diversified bond fund, that already may exist. You can argue about the difference between active and passive, but there's a reason why somebody might want to just own a broadly diversified bond fund, isn't there?
That's the premise of Bond Blocks, is that yes, it was really important for you to be able to own a broad diversified bond fund. It was really important to have access to that through the ETF and to make your allocations in fixed income so simple with ETFs. That was 20 years ago, and these markets are not the same markets they were 20 years ago. They're not the same markets they were 2 years ago. And so Bond Blocks has a products that allow you to see all the different areas of risk in fixed income to be more precise in that broad portfolio. If you build your portfolio with different components, you can put them on, you can take them off as you see fit. So that's one reason. And then the other thing is that that's for a certain type of investor that has a viewpoint and can implement it. There are most investors need help, and they need a fund that is broadly diversified and managed for these opportunities that are out there.
Yeah, well, let me pick up on that, Jerome. There have been very strong inflows into bond ETFs this year. I think 150 billion, including actively managed bond funds that you do. You've said before, active management in bonds does better than active management in equities. That's an interesting observation. Why do you believe active management in bonds can do better than active management in equities?
It comes from a variety of reasons, and you sort of hit on it a moment ago, which was the structural timing or the market timing element isn't really what's driving the returns in active fixed income. Rather, the composition of the indexes themselves lends itself to structural, perhaps, opportunities over this point in time. If you think about a fixed income universe, and specifically an index, maybe even the ag, it's one that has companies which are based on indebtedness. So the largest positions in that index are going to be the ones that have the highest amount of indebtedness. You may or may not want that exposure. And so as a result, the country segments, how issuers are coming to market in terms of investment grade, et cetera, those are opportunities which ultimately change the composition index. The ability to deviate from that in a rational way using research, using liquidity metrics, and frankly, just looking at what the value opportunities on an absolute and relative basis, that allows you to create opportunities in terms of excess returns to the benchmark rates. So the structural element there is fundamentally different from what you find in the active equity segment. Just leaning on one other thing here, Bob, you mentioned, obviously the flows that we've seen into this segment. From a macro perspective, the fixed income, the actively managed fixed income ETF segment is only about 15% of the total fixed income universe. But yet this year, the inflows are about $50 billion, representing 35% of the actively managed universe. Why is that? Because we're beginning to see that differentiation. rates are moving, credit spreads are moving, opportunities are changing. And as those incremental investors come to the marketplace looking for fixed income solutions, they're focusing on how to create and embrace that differentiation, recognizing the fact that they may not necessarily have the tools at their fingertips to do that, but realizing that market practitioners like PIMCO perhaps bring those opportunities in a different form in those fixed income ETF vehicles.
Before I let you go, I just want to get your thoughts on where you think bond yields might end up. The viewers, I know it's a scoreboard question, but 10-year yields at the end of the year, we're below 4% right now. Where do you think we might end up?
I think some of our research would say we'll end below 4%. So I wouldn't change anything.
So the trend is down, definitely.
Trend is down, yeah.
On yields. Jerome?
Yeah, we think there's a few things to calibrate here. Number one, what is the term premium market? Meaning, what does it ultimately mean to own longer dated securities, and what are you going to earn by owning those longer dated securities? So our view here at PIMCO is that the yield curve will gradually steepen over the next few quarters, and as a result, we probably want to be at the front of the yield curve. To answer your question more specifically in terms of the 10-year yield, we view it to be fair, right around 4%, give or take 25 basis points or so. But the front end is going to continue to reprice as the Fed continues to navigate what it views to be proper growth outlooks and obviously inflation outlooks over the next few quarters. That's going to be really the focal point of driving returns for many investors who are specifically focused on active management in the near term. So short end yields might fall in money market funds, but the total return potentials could increase across all actively managed segments of fixed income.
Okay, been a very interesting discussion. Two heavyweights in the ETF bond space, folks. We bring you the best people here on ETF Edge.